Everyone's asking, is a recession coming? But what if I told you it's already here, just hidden behind government data, fake optimism, and endless money printing? They tell you inflation's under control, unemployment's low, and the economy's strong. But look closer. Debt levels are exploding, savings are collapsing, and central banks are quietly panicking. This isn't just another downturn, it's the same pattern that preceded every major collapse in history, from the Great Depression to 2008. And the scariest part? They know it's coming. They just can't afford to tell you. In this video, we'll uncover the warning signs governments ignore, how debt and inflation create the perfect storm, and what past recessions reveal about the next big crash. This is the recession they don't want you to see coming. On the surface, everything looks fine. The stock market's climbing. Unemployment is low, and governments keep assuring us the economy is resilient. But here's the truth they won't put in the headlines. We're living through one of the biggest illusions of prosperity in modern history. Behind the numbers, household savings are drying up. Credit card debt just hit record highs. Wages haven't kept up with inflation for years. And yet, people keep spending, not because they're confident, but because they're desperate to maintain the illusion of normal life. Governments call it growth, economists call it resilience. But it's not growth, it's debt-fueled survival. Central banks are trapped. They can't raise interest rates without breaking the system, and they can't lower them without fueling inflation. It's the same playbook we've seen before, right before the crashes of 1929, 2008, and every unexpected recession in between. And while they claim inflation is easing, prices tell a different story. Groceries, rent, and energy are squeezing the middle class like never before. What you're seeing isn't a healthy economy. It's an over-leveraged bubble, quietly cracking under the weight of its own lies. The real question isn't if it bursts, it's when. Because history shows every empire, every market, every miracle economy that ignored reality always faced the same ending. Every major recession begins the same way. Not with panic, but with silence. A quiet shift in the numbers that almost nobody notices, until it's too late. The first trigger is always the bond market. When short-term interest rates rise above long-term ones, it's called an inverted yield curve. It's one of the most reliable warnings in economic history, flashing red before nearly every major crash, from the Great Depression to the 2008 meltdown. And right now, it's more inverted than it's been in decades. The second trigger is corporate debt. Across the world, companies are drowning in cheap loans they took during the low-rate era. But as rates climb, that easy money turns toxic. Defaults begin quietly. One company here, one there, until suddenly credit markets freeze. The third warning sign is harder to see, but even more dangerous: consumer exhaustion. People are maxed out on credit, savings accounts are empty, and spending continues only because no one can afford to stop. That's not strength. It's the last gasp before collapse. Governments, of course, will deny it all. They'll say it's temporary, manageable, or under control. But history teaches one thing. When officials start using words like that, the real storm has already begun. Because recessions don't start when the news says they do. They start long before, buried beneath the data, waiting for one final spark. Every collapse needs a spark. One event so sudden, so seemingly isolated, that it exposes the cracks the world's been ignoring. In 2008, it was the collapse of Lehman Brothers. In 1929, it was a wave of margin calls that wiped out investors overnight. The signs were all there, but no one wanted to believe them. Today, the next spark could come from anywhere. Maybe a mid-sized bank buckling under bad loans. Maybe a sovereign default in a heavily indebted country. Or maybe a sudden wave of layoffs that turns consumer confidence into consumer panic. The global economy is now so interconnected that one failure, one missed payment, one broken promise can ripple across continents in seconds. Central banks say they're ready, that they can manage whatever comes. But the truth is, they've already used their best weapon: money printing. Trillions of dollars were unleashed after the last crisis, and the system never reset. It just papered over the damage. The next time markets fall, there won't be enough room to save everyone. Governments will choose who gets rescued and who gets left behind. Because every economic boom creates its own bomb, and once it goes off, no amount of optimism can put it back together. And when that moment comes, the question won't be, can we stop it? It'll be, who survives it? Every recession begins with numbers and ends with people. Behind every line on a chart, every drop in GDP, there's a family that can't pay rent, a worker who just lost their job, a small business closing its doors for the last time. When the system starts breaking, it doesn't hit everyone equally. The wealthy shift their money, the banks get bailouts, but the middle class? They get squeezed, savings vanish, bills pile up, and wages never catch up to prices. You can already feel it. Grocery shelves cost more every month, rent eats half a paycheck, and fuel prices quietly drain what's left. Governments call it manageable inflation, but for millions, it's financial suffocation. And when people can't afford the basics, trust begins to collapse too. You stop believing the numbers, the promises, the headlines. We've seen this before, in every great downturn in history. The Great Depression, the 1970s stagflation, the 2008 housing crash. Each time, politicians promised a soft landing. Each time, it ended with unemployment lines, empty fridges, and anger in the streets. Because recessions don't just destroy wealth, they destroy confidence. And once the people lose faith in their money, their leaders, and the system itself, the damage runs far deeper than economics. This isn't just a financial crisis, it's a crisis of trust. And it's spreading faster than anyone wants to admit. When the cracks start showing, governments don't fix the system. They manage the story. They redefine what a recession means. They tweak how inflation is measured. They flood the markets with money and call it stimulus. It's an old trick. Create the illusion of control while the foundation keeps crumbling. Central banks print trillions to stabilize the economy, but every new dollar makes the ones in your pocket worth less. They call it quantitative easing, economists call it policy. But you know what it really is? A slow-motion transfer of wealth, from the many to the few. When governments borrow more, inflation quietly taxes everyone who saves. When they bail out corporations, they reward failure and punish responsibility. And yet, every time the cycle repeats, they promise this time is different. The truth is, they can't afford a real correction. A true recession would expose the debt, the corruption, and the fragile architecture holding everything together. So instead, they double down. More debt, more spending. More illusions. They'll say, the economy is strong. You'll see empty shops, layoffs, and higher bills. And wonder who they're trying to convince. Because the longer they play this game, the more it becomes clear. This isn't about saving the economy, it's about saving control. History doesn't repeat, it just upgrades its disguise. 2,000 years ago, the Roman Empire made the same mistake we're making now. To fund its endless wars and promises, Rome debased its silver coin, replacing real value with cheap metal. The denarius became worthless, prices soared, and trust in the empire's money vanished. Sound familiar? In the 1920s, Weimar Germany printed so much paper money that workers needed wheelbarrows just to buy bread. It started as an emergency measure and ended with national collapse. In 2008, banks gambled the global economy on cheap credit, and when the house of cards fell, governments bailed them out with printed trillions. The system never reset, it just inflated a new bubble. Every era believes it's smarter than the last, that this time is different, but history whispers the same warning every time. You can't print your way out of debt, you can only delay the crash. The pattern is always the same. Greed, denial, collapse, repeat. The real lesson isn't in how these economies fell, but in how they lied to themselves while falling. Because every empire, every nation, and every financial system eventually faces the same truth. You can't cheat reality forever. The only question now is, are we next? Storms never arrive without warning. We just choose not to listen. The markets are shaking, the debt is mounting, and confidence, the invisible glue holding this entire system together, is starting to crack. Politicians say it's fine. Central banks say they have it under control. But history says something else. Every great financial collapse begins with denial. Maybe it'll start with a market correction that turns into panic. Maybe a bank fails. Maybe a government defaults. It doesn't matter which domino falls first, because when one goes, the rest always follow. The people who will suffer most are the ones who trusted the illusion, who believed the system was built to protect them. But those who understand the pattern, who study how every empire, every market, every currency has risen and fallen, they'll see what's coming before it hits. The signs are already here. The question is, are you paying attention? This is the recession they don't want you to see coming. But you just did. If you found this story valuable, don't forget to like the video, share it, and subscribe to Financial History Uncovered, where we reveal the past they'd rather you forget. and the future you need to see coming.